Hey, welcome back. It's Nolan Mathias, and today we are talking fixed versus variable rates in 2021. And at the very end of this video, I will give you the exact strategy that we're using and recommending to our clients. But before we get into it, do me that favor, hit that subscribe button, hit that notification button, please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where when we hit 10,000 subscribers, we're going to pay off one lucky person's monthly mortgage or rent payment just for subscribing to this channel. So go ahead, hit that subscribe button. It's totally free and it's totally worth it. Okay, so let's get into it. Let's talk about variable versus fixed rate mortgages in 2021 because the rules have changed, the game has changed, the Bank of Canada's direction has changed, and that means we need a different strategy than we have needed in the past. And my biggest concern right now is people who are taking 5-year fixed rate mortgages and what that means for them 5 years down the road. Because here's what we know. We know that the Bank of Canada has said unequivocally that interest rates are going to remain low until at least 2023. Which means after 2023, they expect that they could start going up. And it may take a little bit longer than that, or they may start going up immediately in 2023. However, if you lock into a 5-year fixed mortgage right now, what that means is that in 2026, you are going to have to renew your mortgage, and you very well could be renewing into higher interest rates. And to me, that is the biggest risk for a borrower right now in today's market. It's not what's happening right now today, it's what could happen 5 years down the road. So what we're trying to do is make sure that we can minimize that risk for people and make sure that you aren't finding yourself in a position where you have to lock into a mortgage at a significantly higher rate. And because you had a 5-year fixed mortgage with a big penalty, you have no other options but to do so because you won't be able to make changes between now and 2026, at least not very easily. So in the past, when we've talked about variable versus fixed rate mortgages, we've talked about two things to consider when you're getting those mortgages. The first is the spread between the variable and the fixed rate mortgage. We typically recommend 1/4 to 0.5% difference between those two rates before you start considering a variable. However, now we're considering that if you can get a variable and a fixed at the exact same price, knowing that at least for the next 2 years, you're not going to have to worry about interest rates going up, well, then we definitely suggest taking a variable. The other thing that we've suggested is that you consider both your risk tolerance and, if you're in a relationship, your spouse's risk tolerance when it comes to having a mortgage that could increase in payments. And that has changed drastically because now what we're talking about is not the risk tolerance with respect to interest rates going up. We're talking about the risk tolerance with respect to interest rates jumping significantly in 5 years upon renewal. And what we're doing to try to mitigate that potential issue is we're putting people in variable rates so that their interest rates gradually increase and therefore they don't have to worry about a big payment jump in 5 years. What we want to do is we want to do two things. Make sure that we don't renew into that higher interest rate, but also that we are extending the amount of time that we can get a low interest rate for. Because here's what you know if you get a 5-year fixed mortgage rate right now. You know that for the next 5 years, you are going to have a low rate. However, you don't know what it's going to look like after that. But with a variable rate mortgage right now, what we can do is take a variable, have a low rate for the next 2 to 3 years, and then when interest rates start to rise, then we can start looking at options. So maybe we lock into a 5-year fixed at that point in time, and we extend our rate runway from 5 years to 8 to 9 to 10 years by using a variable for a short period of time and then switching into a fixed and therefore getting a longer period at low rates. Or perhaps what we do is in 2 or 3 years when interest rates start going up, we look at other variable rate strategies and see if we can lower the rate by getting higher discounts and whatnot. But the main thing here is that we're mitigating risk by understanding the fact that we pay a premium for a 5-year fixed mortgage, both on the interest rate and also on the penalty down the road. Variable is very much the strategy of the day. Since July, we have not had a single client who hasn't taken a variable rate mortgage with us. And quite frankly, it's because they know that they're going to be able to extend the amount of time that they can get a low rate for because the Bank of Canada has said very clearly the next 2 years are basically low rates. So you get to hold a variable rate mortgage for the next 2 years without risk of interest rates going up. Now, the other thing that you get to do by holding a variable rate mortgage over the next 2 to 3 years is if the discounts increase, you have the opportunity to refinance your mortgage, pay a 3-month interest penalty, which is usually about 1.5 payments, and get lower rates by taking advantage of being able to refinance and switch to a different lender. Now, this is where product selection comes into play because you want to make sure that if you're taking a variable rate strategy that you are steering as far clear of discount rates as possible. Yes, it might seem tempting to take an ultra low variable rate at prime minus 1.5% because you think that rates can't get any lower. But here's the problem. The problem is that when you go to lock in, the bank basically has control, because what comes with a discount mortgage is often what's called a bona fide sale clause, or basically a no refinance and a no leave to go to a different lender clause. And what that means is that in 2 to 3 years, if you go to lock in your variable rates because it is clear that interest rates are starting to go up, well, you may not be able to get the best rate when you go to lock in, because if they know that you can't leave and go to a different lender, what is their incentive to give you the best rates that are available? They're either going to tell you, hey, listen, you got to ride it out and keep that variable rate. We don't care if interest rates are going up, or you're going to have to take a slightly higher fixed rate than what we might otherwise offer you, quite frankly, because you don't have the ability to leave and you have no other options. So making sure that we get the right product for this variable rate strategy and for variable rates going forward is hugely important. And there's two that I suggest. The two that I suggest are Scotiabank and First National. The reason why, and you can see this in our other videos about the best banks in Canada to get a mortgage, is quite simply that they have the best mortgage products. And what I like about First National and Scotiabank is that one, First National only carries one set of rates. It's their best rates. So if you go to lock it in, you're paying whatever the market rate is, not some inflated rate because you can't leave the lender or because they want you to negotiate. And if you take a Scotiabank mortgage, it has all the tools, all the bells and whistles, but also the ability to pay that 3-month interest penalty and leave if they don't offer you a good lock-in rate. And what that gives you is that gives you the power to negotiate. And as soon as you take a discount mortgage, you're losing your power to negotiate after you've signed on the dotted line. But having a Scotiabank or a First National mortgage that isn't a discount rate really gives you the power to do things in the future that will save you a pretty significant amount of money, including refinancing to a lower rate if variable rate discounts get better. Now, a lot of people are going to watch this video and they're going to say, hey, I can do this. I can manage this myself. I'm going to go ahead and get a variable rate mortgage. I'm not going to call Nolan. I'm not going to do it through Mortgage 360 or a mortgage broker because I think I can manage this on my own. And some of you may be right, but the majority of you are going to want to have somebody to manage this strategy for you from two perspectives. One is there's going to be points where there is going to be a temptation to want to lock in a mortgage rate because it looks like fixed rates are going up, but other rates are staying the same. And you're going to want to have somebody who can talk you off that ledge if you're thinking about locking in at the wrong time. And believe me, we do that quite often with our variable rate clients. In the last 2 years, I've had several clients that wanted to lock in at 2.75 or 3%, and they are very happy that I convinced them not to lock in their variable rate mortgages now because they've saved a significant amount of money. The second reason you're going to want to have a mortgage broker manage this strategy for you, specifically a mortgage brokerage like ours, is because we watch what's happening with interest rates, and we can usually tell 2 to 3 to 10 days before interest rates start to go up that they're actually going to go up, which means that we can let you know before interest rates go up that they're going to go up, and then we can talk strategy from there. We can talk about taking a 5-year fixed, or we can talk about refinancing into a lower interest rate, or in general, we can just talk about the amount of money that we've saved over the long term with respect to taking a variable instead of a fixed, and then consider whether we want to actually lock into a fixed and basically lock in the savings. Now, I firmly believe that mortgages are like any other form of financial device. You want to make sure you have an expert you can rely on to help walk you through the difficult decision-making process that is ahead. Because taking a mortgage that is on a variable rate strategy definitely requires more management than just taking a 5-year fixed and forgetting it. However, that being said, the ability and the potential to save a significant amount of money over time is definitely there with a variable rate mortgage right now. And let me make this clear as well, is anybody can save you 0.1%, 0.2%. We see brand new brokers coming out of the industry saving people money, and that's awesome. We see bankers saving 0.1 or 0.2% all the time for their clients. However, managing a strategy and saving tens of thousands of dollars requires significantly more sophistication and significantly more effort. And that's what a really great broker will provide you, is the ability to save you money over time. And just that ability to extend your rate runway from 5 years to 8, 9, 10 years at low rates is worth every penny when it comes to getting a great broker and getting a great mortgage like the ones that we promote at First National and Scotiabank. And that being said, this mortgage channel is made possible by our mortgage brokerage, Mortgage 360, and I hope that you would at least consider giving Mortgage 360 the opportunity to set up and manage this strategy for you. We belong to a network of brokers that can help you get a mortgage across Canada. Ourselves, we are licensed in both Alberta and Saskatchewan, and are just in the process of finishing up our BC and Ontario licenses. So we very much can help people across the country. Mortgages these days, thanks to COVID, are very much done over online and over the phone. So we are happy to help you in any way that we can. And in addition to considering Mortgage 360 for your mortgage, I'd also love it if you did us that other favor and hit that subscribe button and a notification bell. And please hit that like button so more people like you can see this video. As of this recording, we are now just under 2,000 subscribers. I fully suspect that we'll be at 10,000 subscribers by June. The amount of viewers and the amount of people that are commenting is through the roof. I'm so happy that we've built this little community of people who are getting educated on mortgages and personal finance. And don't forget about our race to 10,000 subscribers, because one of you is going to win your monthly mortgage or rent payment for a month just by hitting that subscribe button. So please do me that favor, hit that subscribe button, and we'll see you on the very next video. Cheers.